Let me now introduce our speakers for today. Mr. Adam Millhouse has over 10 years of experience in investment banking and equity capital markets. He currently works for Macquarie Group in Hong Kong as an associate director in the company's Commodities and Global Markets division. His experience spans across different regions, including Sydney, London, Singapore, and Hong Kong. Mr. David Millhouse, Head of China Research of Forsyth by Asia. David has more than 15 years of experience in Asian financial markets, predominantly on investing in China. He started his career at Goldman Sachs before moving to Credit Suisse, JP Morgan, and Bennelong Asset Management. Then he became one of the founding partners of Aviate Global. Both David and Adam are graduates of the MSGF Class of 2016. Please join me in giving a big welcome to David and Adam.
Thank you everyone for your time, and thank you to HKUST for having us back. My name is Adam Millhouse, and David and I are here today to just run you through what we took on for our integrated project during the program last year. And for anyone considering the program, I would certainly say it was a fantastic experience, incredibly well run, and I can speak for both of us, we took a lot out of it, so would certainly recommend it. If you did want to have a chat about it after the session, please feel free to come up or get in touch with us anytime. So how did we get here? When David and I sat down and thought about what we wanted to do for this project, we were both keen to do something China-related, given A, its importance to the global economy, but also the fact that we were living and working in Hong Kong. And you might recall towards the beginning of last year, there was a lot of concern in the marketplace about debt in China. And so we figured we'd take it on with the hope of at least trying to understand what was happening and perhaps at least test some of what seemed to be a consensus claim out there regarding the inevitable collapse in China and China debt. What we decided to do, or how we decided to tackle this, was first to have a look back at previous banking crises throughout the world and try to understand the anatomy of these events and to see if we could extrapolate any of these learnings into the situation in China today. So when we hear banking crises, debt crises, what exactly are we referring to? Well, to steal the World Bank's definition, a banking crisis is a situation where an economy faces large-scale financial and corporate distress within a short period. So in these situations, non-performing loans increase significantly. This places a lot of stress on the banking sector, obviously, but then this also has a lot of downward pressure on asset prices and economic growth. We were surprised to learn that these are actually very frequent occurrences. I think every country represented in this room would have had one in the not too distant past. Our country, Australia, had a massive one in the early 1990s, which was very painful for all involved. But they were very frequent and they were very diverse. They're all very different. They're brought on for different reasons, different triggers. But the one factor which we found which occurred throughout all of them was an unusually strong accumulation of debt. There are other things, unsustainably high economic growth for a period of time, asset bubbles, and other sorts of financial imbalances, but it really is this strong and rapid accumulation of debt which was the recurring theme. So with that in mind, why is China in focus? As this chart demonstrates, post the financial crisis, you saw a very large and quick ascent or increase in the non-financial debt of China as a proportion of its GDP. And if you look at how this is broken down, and sorry if this chart isn't overly clear, but it's the corporate sector which was largely responsible for this rise. So we had a look at this, and as a starting point, to quote the IMF, that over the last 50 years, they only found 4 countries which had a similar increase, both in scale and in speed, in leverage. And all 4 of those countries ran into problems very quickly after their very large increase in debt. There's been a lot written on this topic, some really credible and fantastic reports, and just to have a look at a few, some very good analysis from the Global Research Institute just looking at China's debt versus, I suppose, its phase in the development cycle and also versus some peer groups in emerging markets. And it found that even after conditioning for factors that might justifiably lead to it having high debt, it is still a debt outlier. The Bank for International Settlements, the work which they've done on the credit to GDP gap is interesting. This basically captures how a country's debt to GDP ratio deviates from its long-term trend. And what this analysis found is that, as an indicator, China is now 3 times over the threshold that it uses as an early warning indicator for banking distress or some form of disruption. Now, if you look at this for China back throughout history, it's basically, the reading for China is at the highest level since 1995, which we'll come back to shortly. But this measure was also found to be the most statistically powerful predictor in this study from the BIS. The IMF also did some analysis on the credit to GDP gap and compared the situation in China today with the experiences of Japan, Thailand, and I'm forgetting one other, Spain, in the lead up to their crisis events. And the conclusion was essentially that they saw a very similar experience in China today. They also found that they only could find 43 countries over the last 50 years or so which had had an increase in debt to GDP in such a short period of time of the requisite scale. And 90% of these countries ended up experiencing some form of debt or banking crises. So at a high level, you hear these things and you think, the market's probably right to be concerned. The problem which we had is when we studied a lot of these past cycles, we didn't find a lot of these experiences to be directly comparable with China. China is indeed unique, very different, and a lot of the triggers we didn't feel were there. I mean, China, as I'm sure most of you know, it doesn't really have the balance sheet at the sovereign level of a typical balance sheet crisis. It doesn't have the external vulnerabilities of a typical emerging market crisis. We did, however, find 2 examples which we thought are worth just dwelling on before we move into the analysis we've done. And the first one was, of course, China's previous NPL cycle. It actually wasn't that long ago. So in the late 90s and early 2000s, NPLs in China, and this is official statistics which we drew from the World Bank, peaked at around 30%. Now, research reports we found at that time, so non-official figures if you like, had much higher levels. I mean, one report I found from an investment bank estimated NPLs in China closer to 60% during this time, but this is the data we had to work with. And I think the point to note here is that this event, this NPL cycle if you like, it followed a very rapid increase in debt during the period in the 90s, and a lot of this debt was channeled into SOEs. But China got out of it. They looked back at history and found some very innovative ways, or very clever ways, to clean up the banking system. The point we'd make, though, is that it was a very costly exercise. I mean, you had the creation of asset management companies to create bad banks. You had injections from the MOF and the PBOC. They had to dip into their foreign currency reserves. And the IMF estimates that the whole event, it cost them about 18% of GDP to bail out the banks, clean up the banks. And there was a total corresponding output loss of 37% of GDP. So these are very big events. They're very costly events. I would also say, when you look at this period in time, 2002 is when things started to improve a little bit for China. You'd also recall that in 2001 they entered the WTO, and that had a very big positive impact on exports. And from this time, we essentially entered one of the strongest bull markets or global growth cycles that we've had in quite some time. So timing-wise, there were a few things which arguably helped China along and work out its bad debt problem. The next event which we'd flag, we found the parallels between the 2 experiences to be remarkably similar, and that is Japan. So if you think about where we came from, so think of an economy largely agrarian, not very developed. It then transforms itself, and it does this by implementing policies of financial repression, taking these savings, channeling them into investment in the economy, mainly through policy, government-led financing, SOEs. It also has this parallel with a very strong manufacturing strategy, and you then become the world's leader in manufactured goods, steel production, so on and so forth. It sounds a lot like China, but before China it was actually Japan. So you can see when Japan industrialised post the World War II episode, you start with very high savings rates, both China and Japan, very similar, slightly different scales, but similar. You then channel those savings into investment, and here we've looked at gross capital formation as our proxy. And again, you can see slightly different scales, but similar magnitude, well above global averages. And this is all about infrastructure. It's about fixed asset investment. And it's with the help of SOE-like vehicles, or national champions, and policy-directed lending. The problem is there's a shelf life for this strategy. At some point, your investment, the quality of that investment starts to decrease. The proxy we've used here is the incremental capital output ratio, and this essentially calculates how much additional capital investment you need to generate a corresponding unit of incremental output. As you can see with Japan, it peaked at about 9% at the very height of Japan's boom before it really got into trouble. China's is now following a similar trajectory and is currently at 7 and it's still rising. So this is a symptom of, again, overinvestment, if you like, declining quality of investment, capital misallocation, overcapacity, whatever you want to call it. But we think they're following very, very similar paths. Now, all of this is financed, as we said, with credit. It goes into the corporate sector largely. And this chart shows the trajectory of this non-government, non-financial debt, and non-government. You can see the inflection point for China was indeed post the financial crisis, when the very large fiscal stimulus was implemented, and it's following a very similar path to Japan. Another problem is that all of this at the same time, it causes your velocity of money to collapse. So this blunts the impact of your monetary policy. You're already running very hard on the fiscal side, now your monetary policy doesn't really work. So you've seen that collapse in both countries, and again, following very similar paths. Now, what we found as well, the parallels in the growth models for these countries were equally apparent in the banking system. So if you look back at Japan, what we saw was growth starting to slow, but the banks continuing to lend and lend aggressively. That inevitably means that you are pursuing riskier lending. Your practices are perhaps not up to scratch where they should be. In Japan, you saw a big focus on collateral over cash flow, and we'd argue that you see some similar trends in China, and that's fine when asset prices are rising, but when they come under pressure, which they did in Japan, you've got corporate profitability under pressure, collateral values start to come under pressure. You're having to loan mortgages to stand still, your return on capital's going down. You can see where we're coming from. The other big problem is regulations in Japan did not keep up with the development of the banking system. Okay, and what you saw in Japan was NPLs were actually very, very slow to materialise. The Japanese, when they started getting into problems, they used asset management companies as well to try and get themselves out of trouble. They tried to outgrow their problems. But we all know how this ends. But it was actually it was almost a decade after a lot of these warning signals in Japan were really flashing red that they collapsed under the inevitable pressure which they were facing, and they're still trying to really clean it up today. Before I hand on to Dave, just to take you through some of the analysis, I think the two big things we took away from looking at the Japan case was, firstly, it is possible to have a banking crisis even if you have very high domestic savings and limited external vulnerabilities. And the second point, I think, is what I mentioned earlier. When you have your financial markets developing rapidly and with big scale, it's really important for your institutions and regulations to at least keep up with it, hopefully be in front. Japan obviously didn't do this. And the risk for China is that perhaps it's going to run into the same problems with its regulatory stance. I'll hand over to Dave now to take you through some of the analysis we found.
Thanks very much, Adam. I'm going to keep the analysis reasonably brief in terms of we can go into as much detail as you want, and obviously you're more than welcome to read our report. But what I wanted to spend time on, I guess, is firstly how we did it, and then more importantly on where we see China going and some of the, I guess, policy and market implications from it. So I guess first on what we did. As Adam said, the biggest proportion of China debt is corporate debt, and it's actually doubled into about 150% of GDP. It's actually 157% of GDP now, so that doubled since the GFC. And that corresponded with a lot of very high-profile warnings. Adam mentioned the IMF that said that NPLs in the banking system were going to go to 15.5%. You also had some very high-profile US investors, which I've had the privilege to meet some of them, saying that NPLs were actually going to 30%, which is similar to where China peaked out the last cycle. So obviously for us, it was a pretty interesting predicament, and we wanted to really quantify this rather than a lot of the analysis we saw in the past is really just having a guess and say, all right, here's where effectively past NPLs have peaked out, here's some analysis of some other countries, and effectively we wanted to go into the China financial markets in as much detail as we could. And obviously, as you'll appreciate from people who've looked at China historically, it is incredibly opaque banking system. So I think the first thing we really wanted to do is find out as much detail as we could in terms of the corporate book from the banks. So we relied on the equity market for this a lot, and luckily enough for us, since the Asian financial crisis, a large number of Chinese banks are now listed. So we got every single listed Chinese bank that we could, and we did a bottom-up analysis of all their loan books and aggregated it. So we could get some sort of approximation, first and foremost, of where in terms of banks' loan books are by sector. And also an important point to look at was what was SOEs versus what was not SOEs. And we can come back to that later because that's a heavily debated topic between China bulls and China bears. So effectively, after doing that, what we wanted to have a look at is where are the vulnerabilities? And by that, what we had a look at is China's last cycle, what sort of sectors came up with vulnerabilities, in the existing stock of NPLs, where those vulnerabilities were at the moment, where NPLs were actually materialising. And then the two most interesting things for us was the corporate bond market, because as you guys will recall in the first half of last year, we actually had a big spike in corporate bond defaults. So we had to look at those bond defaults, why they're developing, what sort of characteristics they had, what sectors they were centred in. And then the final part of data we looked at was actually probably the most interesting. And it's not very well understood, but one favour that China did for us last year is they started putting all their bankruptcy data online. So we could go into every single bankruptcy, see what sector it was, how big it was, what the lenders were effectively, if it was SOEs or not. And effectively, once we did all this analysis, we wanted to go into 3 different methods of forecasting NPLs, which I'm just going to skip through to get to the final page. But effectively, we did bottom-up analysis, we did a VAR, we did a lot of different credit risks on the equity market, and probably the most interesting analysis we did was Altman's Z-score, which we were lucky enough through the program to spend a lot of time with Professor Altman when we were in New York. And if any of you are on Bloomberg and you look up a US company, you can see what's called a Z-score for that company. Now, in 40 years in the US, this has never been beaten in terms of a predictability for bankruptcy. So we went and with Professor Altman's help, we rebuilt that for China. Now, effectively, what our analysis came out with was the NPLs in China would peak out around 10.5 trillion renminbi. Now, what I really wanted to highlight here is by doing it 3 different ways, the good thing for us is all 3 of them came out pretty similar, which was encouraging.
Lucky.
Yeah, very lucky. And also within that, the other 2 things which were pretty similar was the sectors which it screened, and also the proportion of state-owned enterprise debt versus non-SOE debt. So, you know, obviously this is a reasonably opaque area. As we said, we tried to be as robust as we could with the data and the analysis. And this is effectively the number that we came up with. Now, what I really wanted to highlight is, so if you looked at where NPLs were at the time, they're about 1.67%. So this had NPLs effectively peaking out at about 11% within the corporate book. Now, if we took a 70% loss ratio, that means we're going to lose about 10.8% of GDP. Now, what I wanted to highlight here is if you have a look at China's last cycle, the Asian financial crisis, and Japan, this number is very manageable. You know, it's obviously far less than some of the extreme warnings we saw in the press. So that to us was encouraging. But one point I wanted to highlight on that is, and this is a lot of follow-up analysis my brother and I have done, I've actually recently done another report on this, is a lot of the vulnerabilities we see, and if China's actually going to find a financial shock, it's actually going to be in the shadow banking industry, not the corporate book. And I'll come back to this in a second. So remember, our analysis on NPL assumed no contagion into shadow financing and no contagion into the consumer book. So what we did in our note as well is what we want, and what I want to mainly focus on now is policy recommendations, because as I said before, the size of China's potential NPLs right now are quite manageable. But policy at this juncture is critically important in terms of where we go from here. So what we did is we had 6 firm recommendations looking back on past currency crises and where the government is right now. And the first thing we really said is, obviously, the government needs to act quickly. Now, as Adam alluded to earlier, if we're having a similar conversation in 3 years' time and we have a similar growth model with China where they're heavily reliant on debt-funded fiscal policy, total debt to GDP is going to be over 300%. If I take an extension of that, one of the good things about China's growth at the moment is obviously the proportion of growth from consumption is increasing. So if I look at the Q1 data for this year, consumption growth was about 75% of total GDP growth. Now, that's great. But against that, the point that I'd make is consumption growth in China is getting driven by income growth. The problem that I have with income growth in China is when we have corporate debt at 157% of GDP and corporate profitability anemic, I don't think that corporates can continue to maintain this double-digit growth in income that we've had every year for the last 7 years. The other thing I'd say is, with China's growth model at the moment, you guys all know we have a GDP target where Xi Jinping came out and said he wants to double GDP per capita by 2020, which will rely, and that will rely on about GDP averaging about 6.5% up to 2020. Now, while consumption's a growing proportion of that, obviously, as I said before, investment in infrastructure has been a big proportion of that as well. So when I look out to 2020, if that growth model doesn't change, the problems we have from consumption is not just the corporate stress that could affect income growth, it's also there's some structural vulnerabilities, which is China's running straight into the middle income trap. Also, demographics are working against China. And also, I'd argue as well, is if you have a look at the Gini coefficient as well, consumption really is driven by urban at the moment, not rural. And so we have this predicament at the moment where urban wages are about 4 times rural. Also, obviously, we've had urban land reform and we haven't had rural land reform. And so that would be a big detriment to longer-term consumption unless we can unleash that. The other thing in China, we have a very high savings ratio. And the reason for that is twofold. Obviously, a very underdeveloped private healthcare system and a very underdeveloped pension system. So unless we can see policy shift away from dealing with short-term economic issues and fiscal funding, debt-funded fiscal policy, towards dealing with some of these structural reforms to promote consumption, we could be heading into 2020 with a lot more elevated debt and quite a severe slowdown in growth driven by consumption as well. The other points we wanted to make was on the credit allocation process. Now, through our analysis, as we said, we spent a lot of time on SOE versus non-SOE debt. So in total, since 2008, SOEs have monopolised about 70% of China bank lending. Now, the problem that has from an economic perspective is SOEs are less than 20% of the size economy. So we've had this massive misallocation of capital over the last 8 years, which needs to be addressed going forward. The other thing we'd add on that is with capital market reform is the problem with the growth of the banking system as well is it dwarfs the asset markets. So China has an incredibly large banking system and it has an incredibly underdeveloped equity market. So the equity market is only about 4% of corporate funding in China. Now, the bond market is big, but it's incredibly illiquid. So it's actually the world's second largest bond market, but it only trades a tenth of the value of the US bond market. So effectively, the problems that we have within the banking system of the private companies being able to get access to capital, they have similar problems within the asset markets as well. So this is another problem that China needs to address in the future. And I think the final thing that I wanted to lead on, again, this is a whole other topic of conversation, but the developments in shadow financing are very problematic at the moment. Now, Adam's points on China's debt accumulation are pertinent, but one thing I would say to you, it's not the size of China's debt that by itself is the problem. It's the way that the banks are funding it. So if I look back to 2007, wholesale funding in China was anemic. And obviously the big 4 banks were about 60% of the total banking system. Now, since then, we've had huge growth of the small and medium-sized banks, and that has been driven by wholesale funding. Now, in aggregate, at the end of Q1 this year, wholesale funding for the mid and small-sized banks was 28% of total funding. Now, that by itself is not a problem, but it's how they're doing it. So I'm going to keep this pretty simple because it's a reasonably complex topic, but you will all remember what happened in the US and the GFC. So if I just keep this simplistically, a lot of mid and small-sized banks are issuing wealth management products. Now, these products are very opaquely regulated. Now, the problem that they have with that is they're effectively taking savings, as Adam alluded to, and they're investing in other banks' wealth management products. And they're leveraging them, and they're putting them in opaque areas of the economy. On top of that, they're also investing in other banks' receivable investments. So if I look at China in totality, there's 28 trillion renminbi of outstanding wealth management products, and the banks own 21% of them. So this cross-contagion of risk within the banking system, which has developed over the last 3 or 4 years in particular, has been enormous. And it gets back to the slide that we said earlier, where the IMF actually estimated that 19 trillion renminbi of shadow financing assets within the banking system are at risk of defaulting, which is double what Adam and I forecasted for corporate NPLs. I'd leave it on, the good news out of that is Adam's point earlier that Japan had a real problem with regulation, where the size of the banking system ran a lot quicker than regulation. Now, China has unquestionably had that problem for the last 3 to 4 years. But one of the really positive developments of the last 3 months is we've had an increased coordination from the PBOC, the banking regulator, the insurance regulator, and the stock regulator to increase regulation around shadow financing. And we've had 10 different documents issued by the banking regulator, 19 from the insurance regulators. So the point I'd make to you is, yes, this is a risk, but we don't think the China government is sanguine about this risk. And I think we're going to get a lot of regulation, in particular in the next 2 to 3 months, in terms of trying to de-risk this.
I'll leave it with that. Okay, so just to conclude quickly, hopefully we've shown you today that when you consider cross-country evidence, and when you look at what's happening in China today, there is reason to be concerned. It is unusual. And when we look at scenarios in other countries and how they played out, it's understandable why commentators or financial markets may be a little uncomfortable with what's happening in China from a debt perspective. But our analysis shows that the damage done to date, it is significant, it's meaningful, but in the context of the resources of China, it is manageable. The problem for here now is what happens next, because as David said, if China continues under its current model, under the current trajectory, the magnitude of the problem is going to explode. It's going to become harder to control if something does go wrong. And to quote some empirical analysis that's been done, the probability of an adverse outcome increases if a credit binge lasts longer than 6 years. So China now has done 8. It's soon to be entering its 9th year of very rapid excess credit growth. We do think that policymakers are aware of the risks, they understand it. Seemingly they are still trying to grapple with what is the right strategy, what is the comprehensive strategy. And obviously this is a very complex topic with a lot of different vested interests. I might conclude by just saying David and I are going to continue to follow this topic. We're going to update some of this analysis over the next little while. But for those of you in the audience out there that are also interested in this, and would like to get in touch or correct us where we're wrong, we'd be delighted to talk to you. Thank you again to HKUST, and thank you all for listening.
Thank you very much, Adam and David. So before we move on to the Q&A session, I'd like to introduce some of our faculty guests. Joining us today are Professor Veronique Lafond-Vinesse, Project Director of the MSGF program, and Professor Casper Nielsen, Academic Director of the MSGF program. May I now invite Professor Veronique Lafond-Vinesse to join the Q&A session, and we will also be inviting questions from the floor.
Well, it's a great pleasure to have the brothers, the famous brothers of the MSGF program with us, talking about the great work that they did. I had nothing to do with it. And I would like to open the floor for questions. I'm sure you're burning with questions about this hot topic, especially in the aftermath of the downgrade of China by S&P, which was sort of anticipated in your conclusions. Do you have any questions? Okay, the gentleman over there. Please say your name.
Can you guys hear me? Perfect, there we go. Okay. First off, well, I'm Ryan Hobbs. Thank you guys very much for your explanation. I thought it was very well thought out and very easy, well, I wouldn't say easy to follow along. It looks like there's a lot of work put into it, but you made a compelling thesis. Not to veer too far away from the NPLs in the corporate sector, but the shadow banking sector is very, very interesting. If you were going to explain it to a layperson, what's the regulator's playbook to help these insurance companies and these banks try to kind of unwind some of these WMPs and these short-dated investments that they maybe have an ALM mismatch on? I know they're not letting them kind of issue more at the moment to try to continue the financing, but what's kind of their playbook from your perspective? Thank you.
Yeah, I'll take that. Great question. I think there's three things at the moment. I mean, obviously, we had a new head of the CBRC come in February, and he made it very clear that we were going to go through quite an intense period of scrutiny from the regulator onto products on the bank's balance sheets and off the bank's balance sheets. Now, when I look at this, there's two types of problems. First and foremost is funding. So on the funding side of the products, there's two things which really concern me. Negotiable certificates of deposits, which, you know what they are, effectively banks bidding and borrowing from other people's deposits and structuring them and on-selling them. Now, this was a huge form of funding in Q1. It was about 5.4 trillion renminbi. Now, they've been under scrutiny for about 2 months now. Now, the problem that has created is, your point is pertinent, they said effectively no more. So they're bringing NCDs which were off balance sheet onto the balance sheets from banks. Now, obviously that increases the provisioning. So effectively at the moment, we're under a period where interbank rates are going up quite aggressively because banks can no longer issue NCDs and they're effectively competing for deposits. Now, the second thing is bill financing, which is a little bit more complex. So explaining that to a layman is actually not that easy. But effectively what I'd say about bill financing in China is it's not an electronic market like it is in the US. And the problem is it's done over the counter, so you can come in and we can do a bill agreement between the two of us where I borrow, like a promissory agreement, I borrow money for you, and it's electronic and it's done with a seal. Now, the problem in the last 9 months in China has been this market has been ripe for fraud. So we've seen about 6 or 7 really high-profile fraud cases as a result of that. So these two types of funding are under intense scrutiny at the moment and largely will be removed. Now, the key thing at the moment, and the CBRC 3 weeks ago said this, is banks will be given a lot of time to recycle capital. So I actually don't think NCDs will come fully back on balance sheet for at least 9 months. So, you know, I think the regulator is pretty clear that at this juncture, with the financial system reasonably fragile, the last thing they want is a repeat of the 2013 interbank crisis, because obviously interbank instability can lead to instability in the corporate bond market. The corporate bond market could lead to instability in wealth management products, which I'll get to, which is your second point. Now, that is when you can start to see contagion within the China financial community. So we've got funding products and then we've got asset management products, which is your question, which is pertinent. So if I have a look at asset management products in China, wealth management products in particular, they've had an enormous amount of development over the last 7 years. So WMPs, as I said, we have, you know, I think the exact number is 27.9 trillion renminbi of them at the moment. Now, the problem with WMPs is they were transitioned on balance sheet in the first quarter this year. And one of the problems within, they're reasonably simplistic products. So if you speak to the banks, and I speak to the banks all the time, they say, well, listen, about 70% of these are invested in bonds. Now, the problem with the way the regulations develop, to your point, and to Adam's point on regulation lagging is, the other 30% has been quite interesting because they've actually been quite innovative because effectively banks have used wealth management products for funding. As wealth management product yields came down, because obviously corporate bond yields were coming down, you had to guarantee or implicitly guarantee a type of return to attract retail people to come in to get these. So what they needed to do is increase the leverage in these products. And the banking regulator last year changed the laws so you can obviously only leverage up 100% on a bond portfolio. So what the China banks started to do is outsource about 30% of the investments with their WMPs into trusts, insurance and hedge funds. And they had no leverage restrictions. So this pool of investments within WMP is actually called entrusted investments, and the size of that is about 11.8 trillion renminbi. And that's what the regulator is looking at the moment. So my point to you, my point to a layman is, okay, the direct implications, first and foremost, are there is going to be stress in the interbank market because as these get regulated, obviously banks need to form more traditional ways of funding themselves, which is interbank predominantly. We're seeing that at the moment. The second thing which I think we'll see is unquestionably a slowdown in M2. Now, this, according to our analysis, and Adam will agree with me, is definitely needed at the moment, so I don't think this is a bad thing. But the third point to your point is, how do you control contagion? And I think there's two ways they want to do this. The firstly, as I said before, is time. So, I think the way the regulators look at the moment is, okay, let's ban the development of entrusted investments, so at least we don't make the process worse. Secondly, let's give them time to unwind them, so just wind down the book. And then thirdly, my conversations with a lot of people domestically is, if there is an event which could potentially be systematic, that's when the PBOC steps in. And I'll give you an example of this from December last year. December was a good taste in terms of how China could go wrong. What happened in December, as you'd all remember, is obviously the Fed raised rates. We had a big move in global bonds, which led to a big move in Chinese bonds. And that coincided with a little bit of what's seasonal instability in the interbank markets in China, because interbank rates generally go up to year end. All of a sudden, we had this big spike in corporate bond defaults. And then, lo and behold, one of the major Chinese brokerage businesses called Sealand Securities, which is an SOE, technically went into receivership. But rather than step back on regulations and take the foot off the gas, the PBOC just intervened and dealt with Sealand directly. And they got the 4 major banks to give them emergency loans. So I think, it's a good question you ask, but I think that's the playbook. Increase regulation, give them time, and to the extent the sovereign needs to step in, they will.
Okay, some more questions from our audience. Over there, the gentleman.
Hi, my name is Michael from the class of 2012. Thank you for your presentation. I just want to ask about what it means for, I guess, the wider Chinese population in terms of the asset bubble, mainly, say, real estate, and, all the banking and the mortgage loans, and also all the shadow banking reform that would likely to happen. What would that mean for, like, small and medium business enterprises?
I'll start and you jump in. I mean, we looked at this, we thought about this a little bit and we thought, could we incorporate that in some capacity? But just due to, obviously, the meeting Veronique's restrictions on length, and also just the complexity of that topic, we thought we'd concentrate on the corporate side. We did have a slide here just acknowledging that, it's very rare for you to just, we realise the assumption of this being contained in the corporate book is not necessarily realistic. And we've got some charts here. I mean, everyone knows what China property looks like. You've got your big hockey stick investment, price is the same, big inventory and a lot of concentration of household assets in the property system. So hugely important. You could argue that, the I don't want to call them bubbles per se, but the financial asset or the asset appreciation in China you've seen, arguably not as extreme as what you saw in Japan yet. So there is some differences there. But in terms of how you see that, what we've looked at and how that manifests itself through the property market, I might let Dave expand on that.
Yeah, I'll expand a little bit and expand on your point more broadly in terms of what this means for Chinese people. I'd say first and foremost, and I'm Australian, but first and foremost, I think any form of vulnerabilities within the banking system will be dealt with by the sovereign. And it's really interesting in terms of what's developing at the moment is Adam outlined you in terms of how China dealt with the banks in 2001. Now, what's happening at the moment is two things. First and foremost, the government is accelerating SOE consolidation. Now, what that means plainly is large SOEs are going to shield some of the burden from the banking system by taking over less profitable SOEs. So we started seeing that last year in steel and coal. This year it's been put into cement as well. And I think increasingly and we saw a similar thing actually in Japan as well, but where you do see large SOEs being able to take away some of the strain from the banking system, we will unquestionably will see more of that in the next 12 months. I think the second point is more pertinent. So in 2001, the China government set up 4 asset management companies, which were the vehicles responsible for taking over NPLs from the Chinese banks. At the moment, they're setting up 40 regional asset management companies. So these regional AMCs are going to be funded firstly by regional local governments and then by bonds, which perversely will be taken by the banks and the insurance companies. But my key point is, I believe in the next 12 to 18 months, a lot of the NPL book from the banks will be taken by these regional asset management companies. And actually in the last 4 years, we've already seen 1.8 trillion renminbi of corporate loans disposed to the 4 major AMCs. But I do think inevitably, these vehicles, which as I said are predominantly local government funded, are going to be entities that wears the financial pain, not the banks, and certainly not the people. So your point's an interesting one, because if you looked at a Western economy, obviously the development of asset-backed securities and sending that through the retail chain is quite an interesting way of trying to effectively pass debt risks off from the banks to the people. But I don't think in China's current model that's palatable Also in the size of development of asset-backed securities, which are incredibly small. I don't think that's scalable in a quick way either. So I strongly think that, you know, government vehicles are ultimately going to be the people that wears the financial stress. Second point I'd make for the people is financial crises throughout history have often had some very good things which have come out of it. And China's no exception of that. I mean, Adam mentioned the WTO agreement and how that helped China in the last cycle, but I think one of the really big drivers which helped China economically in the last cycle, and it relates to your point on property, was urban land reform. It was an incredible driver of the wealth effect. I mean, let's just think about this simplistically. It's like a wealth transfer away from the local governments to the people. And we actually did some analysis on this. As Adam said, we couldn't include it, but I do think from a longer term perspective, what we hope to see in the near future, hopefully in Mr. Xi Jinping's second term, is more progress on rural land reform. And I think that would be fantastic for 500 million people which still legally don't own their own home. I think it would be fantastic for the economy in terms of being able to stimulate more sustainably consumption, in particular in less developed regions. So, as I said, there can be an economic benefit out of this. And the other thing which we touched on before as well is obviously spending more money on social services, in particular in healthcare and pension systems. So from a longer term perspective, they are three things which I think can be very good for the China people and the China economy from a longer term perspective. Your point I'd just finish on housing, yeah, I mean, obviously we have problems in upper tier cities in housing, but it is effectively within 28 cities at the moment. So, you know, we can maybe touch on that in the interest of time with more people afterwards. But yeah, we've done quite a bit of work on that we can talk about specifically on property.
All right, we have time for one. Oh dear. We have time only for one question. Oh, guys, you pick. You know, I'm not going to take that responsibility.
That's your decision.
Not fair.
We can be brief.
Okay, all right. There's a gentleman over there in the middle.
Hi, this is Anil. I have a question about the bond market in general. So the bond market is now opening up. We have the China Hong Kong Bond Connect, right? You said there is no liquidity, and now initially it will be northbound, so international investors can invest in the interbank market. So how do you see that panning out? Do you think international investors would be vying in that option, or like is that a good thing for the general sort of market trend?
Yeah, definitely. I mean, 1.4% of the China bond market is held by foreigners. I mean, you look at the US market, bond market, it's incredibly liquid and it's completely open. So I think China is under no illusion that they need foreign capital, firstly in the equity market, secondly in the bond market. So yeah, I do think the bond market connect is going to be interesting. I think it'll be a slow process. So I'm not sure if you saw that today, but the head of Hong Kong Exchange said it'll be 2 years until Chinese people can invest internationally. So I think Bond Connect will be somewhere around November this year. It will be small initially, but I do think it's significant because I think the second part of Bond Connect, similar with Stock Connect, will be MSCI, I think, will include China next year in its equity index. And similarly, I think a lot of the bond providers will include China in the bond index. So from a slow 3 to 4 year perspective, yeah, I certainly see an increased participation of foreign capital in China's capital markets. And as you alluded to, that unquestionably is necessary at the moment because
Largely you need to see it speed up too, right?
Definitely, yeah. Because they're small versus the size of the banking system. And also, as we said before as well, 70% of the market cap of the stock market is SOE. So private companies still aren't accessing. The bond market is even worse. So yeah, I think further reform and further opening up is unquestionably going to be a big trend and as Adam said as well, is desperately needed.
All right, so I'm afraid I'm being given the stern look from my colleagues over there. Thank you, guys.
Thank you very much, Professor Veronique Lafontanes, Adam, and David. I would now like to invite Professor Casper Nielsen to present our speakers today with gifts.